Good afternoon, everybody. Welcome once again to the weekly webinar presented by Affinity Federal Credit Union. My name is Oscar Cordova, and as always, I'm the External Affairs Specialist here at Affinity. I'm in charge of the financial education efforts for the areas that we cover. Today's topic is payment strategy mindful of our credit. Very important topic for us to learn from because we live in hard times, whether it's a pandemic, gas prices, um, getting our hours cut, being unemployed. There are many things that humanity is going through right now, and we need to put a strategy together in order for us to protect that thing that we've worked so hard for, which is our credit. Before we start, a quick disclaimer: the information provided to all of you this afternoon is for information purposes only. So it's not intended to be actual advice, whether tax, legal, or financial advice. Okay. So if you guys need any, help or you guys want to talk to somebody, I can definitely put you in touch with somebody that can have a one-on-one consultation with any one of you. Okay. Very good. Two more things. One, this webinar is being recorded and every one of you will receive the link to rewatch the webinar at a later time. And also, if you guys have any questions during the presentation, feel free to use your Q&A, and I'll be more than happy to address those questions at the end. Okay, very good. So let's get to it. So as I said before, this topic is very relevant because daily, and we see it watching TV or going online or going on social media, we see how people have been affected by either the economic conditions, the pandemic, gas prices, you name it, right? So we need to put something together. We need to be smart, we need to be proactive, and we need to put a strategy together in order to protect our credit. So during a crisis, many people find themselves in a tough financial position. Often a crisis can mean that your regular income is interrupted. For example, the coronavirus has led many businesses to close temporarily. Luckily, things are turning around and the economy is starting to back up. But many companies closed their doors. So this led to their employees to lose income for several weeks and sometimes months, or sometimes being unemployed. So my purpose today is I want you to be proactive, to be prepared if something like that was to happen. So I want you to be proactive in thinking about how you can approach the repayment of your debt when you're faced with a tough situation of having no income or reduced income. If that happens, it's important to develop a financial strategy to pay what you can in a way that still protects your credit. Okay. All right. So how to prioritize payments. All right, so most experts recommend that you prioritize your bill payments according to what you need the most and what you have to lose if you don't pay. Okay. So this means that you should consider paying for your assets and services that you cannot do without. So this often includes your home mortgage, heat, water, electric, utilities. And so why are these the most important one is because if they can actually materially affect your health and your well-being if they're cut off, right? So if you don't stop paying your mortgage, then eventually the mortgage may fall into something called foreclosure, right? Or if you don't pay your electric or gas, then they'll get cut off. And then this will definitely put you in a tough situation. So as I mentioned, for example, if you stop making the payments to your mortgage, you may lose your home. And if you stop paying your electric bill, eventually you'll pretty much lose everything in your fridge because you will not be able to freeze it or to maintain it fresh, right? So these are payments that need to be made on a monthly basis, and those should be the ones that we should be putting up first, right? Right after those payments that we know that need to be made every month, experts recommend that you pay any debts that are backed by assets. So that those are debts that have some kind of collateral. So you may want to consider these debts as your personal second priority because you can lose the assets if you don't make the payments, right? For example, if you don't pay your car loan, you will eventually lose your car through a repossession. Or, I mean, of course, many months need to pass before you actually get there, but you want to make sure. So sometimes when people lose their job, they may not they may not lose it for a week or two. They may lose it for an extended period of time while they look for another job and while they interview for a new position. So thinking about that, you don't want to start making those payments to your vehicle because you may fall into that situation of a repossession. Other debts that are backed by assets or have some kind of collateral are the mortgage payment, any loans where you've put up cash or have some kind of collateral that you've put up something for the loan. Okay. And lastly, you may consider your final priority making payments to non-collateralized or unsecured debt. So these are the debts that are not connected to essential services and are not backed by any assets. Failing to make these payments will not put you in immediate hardship, but will eventually affect your credit. So we want to make sure that we categorize all of our different payments in this way. What's the most important? What are the payments that have some collateral? And lastly, what are the payments that are not that important and those does not have collateral, but they'll still affect our credit? So these debts are examples of these debts are credit cards, personal loans, or student loans. Okay. While such debt can definitely cause problems if not paid over the long run, they are the least likely to cause significant issues if not paid during a short-term crisis period. Okay. All right. So next, choosing which bills to pay. All right. If possible, experts strongly recommend that you pay all of your minimum payments first before paying anything above your minimum payments. All right. This allows you to avoid having missed payments on your record, and it's hugely helpful in maintaining good credit. As a rule of thumb, and I've taught this to many people, a person should make more than the minimum payment in order to get out of debt. But when you're faced with a hardship or a loss of income or loss of employment, then making minimum payments will protect your credit while you improve your income situation. Okay. Now, what happens if you cannot do not even the minimum payments? So if you cannot do your minimum payments, then you need to decide to mentally prioritize your debts, either using your prioritization efforts described before, which is what I mentioned to you, dividing your bills and making sure that you categorize each bill with its importance, or using your own prioritization method, right? So what I told you previously about categorizing your bills, that's pretty much what experts recommend. But you may have your own method, right? So you may think that perhaps a credit card that you've used for since you were 18, that credit card is very high in your priority. So you choose whichever way. What I told you just before is kind of like what experts recommend, and it makes sense, but it may not work for everybody. Okay. So if you cannot make those minimum payments, you may want to consider a partial payment. Now, I understand that a minimum payment, if it's not met, it'll eventually affect your credit. But having that minimum payment, that partial payment, I mean, paying that partial payment, even if it's not the full amount of the minimum, shows good faith towards the credit card company or the credit union or the bank. Now, if you find yourself in a situation where you cannot make that minimum payment, then the best course of action will be for you to contact your financial institution, contact your credit card company, your bank, as soon as possible, in immediately, and talk about hardship option. Okay, having this communication venue open, communication channel with your creditors can benefit you because credit companies may be able to provide solutions that you may not have known about if you had not called and asked. Okay, but and I've seen it many times. Many people feel embarrassed of calling the creditors and letting them know that they cannot make the payment. And if you find yourself that you may be this kind of person, that you may feel like a little bit embarrassed about calling and letting people know that you cannot take care of your own responsibilities, put that aside of your mind, because what the country and what the whole humanity went through 2 years ago when the pandemic started, and nowadays with the current economy and everything, it's not only you who's feeling the hardship. Many of us is feeling it, and banks have put together different, I guess what I want to call it, different procedures to help their clients. Okay, you will not be able to know about any of these procedures or any of these benefits if you don't pick up the phone and you call them up and let them know that you're having a hard time. Okay, all right. So how to negotiate with lenders? Okay, so if you're encountering financial hardship due to a crisis, one option may be to consider negotiating with your lenders. While minimum payments can seem like a hard rule because they say, this is the minimum payment. Okay, there are many instances where lenders will be flexible in consideration of a crisis or what we're going through right now, especially if that crisis is widespread. Okay, for example, 2 years ago, many financial institutions have provided financial assistance during COVID-19 pandemic by waiving fees and allowing customers to defer payments on debts. Now, I know that the pandemic, you may think that it's old news because it's been a while already and people are getting vaccinated, but many of these financial institutions may still have these programs and these benefits in place. So it doesn't hurt to call and ask. So it says here it can be of it can be of significant beneficial financial benefit for you to at least ask your lenders if other options are available. When negotiating with your lenders, there are several compromises that may be available to help protect your credit. Like for example, like for example, um, you may be able to defer payments to avoid having a missed or late payment on your record. What is a deferment? Deferment is when a company or credit card company will take your payments and they will add them at the end of the loan, and then allow you to not make a payment during that month. Okay. You may also ask about refinancing your loan to lower your monthly payments if you have been paying for a long time, such as an auto loan. Now, I know there's a little caveat here because if you lost your job, how can you refinance? So in that situation, when there is no income, will be a refinance may not be an option, but there's something called also a what's the term that I'm looking for? There is a I can't recall. That is a situation where a lender may change the terms of a loan. For example, that the rate, they may be able to lower it, or they may be able to change the payment for you to help you while you get back on track. So it says here, other options may include lowering your APR so that future payments of any remaining debt may be lower. For bills such as utilities, for example, these are bills that they're not written by a financial institution, or is not, they don't have an interest rate per se. But for example, with utilities, if you cannot make a pay, if you cannot make the payments towards utilities, you may be able to take advantage of hardship benefits, such as programs already that have been in place by local governments at county level, at town level, at county level, and at state level. Um, so when a major crisis happens, that leads to more programs being developed and put in place. So if you find yourself that you are unable to pay for your electric bill, for your water bill, um, inquire with the your local government, with the county government, and find out if there are any programs available for you to take advantage. Okay. Now, lastly, you want to stay calm and protect your financial future. By its very nature, a crisis is very scary, and we all know that. It can be very easy not to think about your financial situation, and instead of focuses on just getting by or staying healthy in case of a pandemic. But staying calm and developing a financial strategy, it may be very important for you for you and your family. It can help you get through any crisis you may be going through in the short term and protect your financial future in the long term. Remember that your finances are not going to pay away. They're not going to go away if you ignore them. And ignoring your finances can be damaging to your credit. So with that said, we need to stay calm. We need to think about our health. Stress is real, and when we live with stress, and more when it's financial stress, it can get us sick. So it's good to get out of our thoughts about being worried about where the money is gonna come from, and try to relax and try to like stay calm, because eventually we need to do something about our income situation, about our finances. Okay. So with that said, this concludes my presentation this afternoon. I hope it was helpful for all of you. I would like to open up the floor for any questions that any one of you may have. This was a short presentation, but I think it's very important, and I thought that it was important for me to present it now that we're seeing gas prices go through the roof, because now, and everybody's feeling it. Before, I used to be able to get a full tank of gas with $40. Now it's close to 80. And when we see that happening, we can definitely see our income potential be decreased. And we need to do something about it, because eventually our credit card payments, our loan payments, they're not going to go away. So I think that I hope that this presentation was helpful for all of you in thinking about outside the box, and thinking about how we can protect our credit. Okay. Now I noticed that there's a member that raised their hand. If you have a question, feel free to use your Q&A option on your panel, and I'll be more than happy to address that question. While you type it, I just wanted to remind everybody that this presentation is being recorded. So later this afternoon, or tomorrow, you guys will receive a follow-up email with the link to rewatch this presentation. All right, fantastic. Here's the question. If I have medical bills 2 years or older, what should do to increase my credit score? All right, so excellent question. If you have medical bills, now there's something for us to think about here. If you have medical bills that are on collection, then a collection account from a medical option or a medical doctor or hospital, they do not affect credit as much as many people think. I'm not saying that it's okay to have them. Please don't think that I'm saying that you guys should just not pay your medical bills. But in case you do, for example, if you were to apply for a mortgage, and I know that because we just finished the spring home buying series, the webinars that we give to teach people when buying a house. I know that the mortgage department sees medical collections with they're not that important. No, but if you guys do have them, and you guys want to make sure that you want to increase your credit score. So when you got these collection accounts, how was you want to think of yourself? How was my my income situation? Did I had a good job? Did I was I in a hardship? Did I was I unemployed? Because if you were and now you're working, now in order for you to increase your credit score, you may want to um, get in touch with those collection agencies. Now, usually most hospitals or medical offices will sell their collection accounts or their default accounts to um, to collection agencies. So if you call the doctor, most probably they'll say, you know what, you have to call this number because we no longer have that account in our books or in our records. That account was sold to a collection agency. So you may want to call the collection agency. Now, when you call the collection agency, they need to provide proof that this is your account. And I'm not saying that it's not, but what happens is that you just mentioned that your accounts are 2 years old. So what happened? There is a statute of limitations with collections, and if you can always ask for proof that this is your debt, because if they cannot provide any proof, then there may be a chance that you don't need to make payments to this collection account. But I know that because when I used to teach, there was a course that I used to teach about bankruptcy that I believe is 5 years, I think, that if you haven't paid a collection, a medical collection for 5 years, and they haven't actually been able to collect from you, then you don't have to pay it anymore because there's like a statute of limitations for that. So I would just need to do a little research and find out what is that time frame. But in the near future, if you're looking to increase your credit, you may want to get in touch with them and and find out if there's like a payment method or a payment um what is it, a settlement or a payment option for you to like pay off little by little this collection account. Now I noticed that you've been giving me some information on the chat. So it says I have disputed and they refuse to remove them from my record. It is my account. Okay, so if it's your account, then the best thing that you could do will be for you to have a conversation around payment methods or settlement. What's a settlement? For example, if you owe $1,000 and they say, you know what, we will settle for 700, pay us 700 and we call it even. We call it a day. It is going to show up in your credit as paid by a settlement. But sometimes those settlements could be beneficial because you're not paying the full amount. Now, they are beneficial if you have the money, because usually with settlements, they will want the money up front. So whatever you guys are settling for, they don't want to take the money in payments. They'll say, you know what, give us 75% of the debt up front and we'll call it a day. So that's a way for you to save a little bit on that collection account, and that's something um, that you will need to discuss with them. Now, I did notice that you would like to know a little bit about the statute of limitations. So I can do some research for you. If you want to reach out to me after the webinar via email, because I don't have that information in front of me at the moment. But I know that with collection accounts, there is a limit of time where if there is no activity and no payment, after a certain time of has passed, the person is not liable anymore. They don't have to make those payments anymore. Okay. Okay. So the um the payment strategy or a payment settlement or an actual settlement will be the best way for you to increase your score and get rid of all of those collection accounts out of your credit report. Okay. Very good. Thank you so much. Um, oh, thank you so much. I mean, there is a colleague here in the webinar with me, and she mentioned last I checked was 3 years. So there you go. That maybe I'm still gonna do my research on it. But thank you so much, my colleague here in the webinar. She works for lending and for customer service. So most probably she has more up-to-date information than I, but she's saying 3 years. So that's if you already had it for two, you may be very close to that time frame where you don't have to make that payment anymore. Okay. And she mentioned it's for New York, so it may be state specific as well. So again, I will do my research and find out what would it be for New York, New Jersey, and Connecticut, which are the three states where we currently have offices in. Okay, thank you so much for that question. That was great. And I think that there is another question from the same member, or perhaps not. I don't see it anymore. Hold on. Oh, I see it. All right, so there are a couple of questions in the Q&A. My question is about bureaus. They sent emails one day congratulating me for excellent payment record, and the next day I receive an email saying my score decreased. It is very confusing. All right, so, and thank you so much for the question. You're absolutely right. It could be a little bit confusing because you may get a message praising you, and then you get another one saying that it decreased. Your credit score is always changing. It is never a constant. So a credit score is kind of like the your score. It lives. It could be different every day of the month. Okay, it could change from one month to another. It could change from one week to another. The reason is because it depends on how you use your credit. So they the first email that you get congratulating you for excellent payment record, that's usually an email that is sent out as an incentive because you have excellent payment. You're never late. But when you use your credit cards, when you go to the mall, you go to the store and you use your credit cards, that transaction is going to increase your your debt, right? Your debt load is going to increase that balance on that credit card. Eventually you're gonna pay it off, right? Or you're gonna pay it down, or whichever way you manage your credit, right? But when you use your credit, that increase in balance is going to take an effect on the your it's called the debt to income ratio. Not the debt to income ratio. It is a ratio that will take your available credit and compare it to your outstanding balances. So now that your balance is higher, this is going to take effect on your credit score. So your credit score may lose a couple of points because now your balances, your total balances on your credit are higher. When you start making those payments back, you regain those points back. It's not like you lose those points and you never get them back. You get those points back eventually. But those little changes in score may trigger that second email that you get saying your score has decreased. So don't lose sleep on this, because if you score decreases by a couple of points just because you used a credit card, it may not be the end of the road. You know, it's no there's no big deal with that. Okay. Now, another reason why your score may decrease is if you actually apply for credit. So whenever you are in the market to either get a credit card or a loan for a car or a mortgage, then expect your score to be decreased, because when a lender, whether it's a credit union, a bank, or a credit card company, when they put your credit as a hard inquiry, um, it'll decrease your score. So be on the lookout for that. So I understand that these emails may be a little bit confusing, but I just wanted to explain to you why your score may change from one day to another, or from one month to another. I hope this was helpful. Thank you. All right, next question. What's going on with the economy? Should we be more focused on an emergency fund? And if so, how much? Fantastic question. When I teach budgeting, when I teach the budget scores, or even when I teach credit score enhancement, that's another one that I teach. I always talk about emergency funds. And the reason is because not a lot of people have those in place. And it is recommended for you to save between 3 to 4 months of worth of living expenses. Now, this could be a lot of money, right? I mean, just mortgage, for example, in my case, just mortgage is $1,800 a month. So 4 months of living expenses just on the mortgage is close to what, $7,500. That's a lot of money for me to save and keep on an emergency fund. And let's forget about the car loan or the insurance or food or everything else, right? But that's the recommendation. Now, a lot of people get scared, right? A lot of people say, "Oh wow!" So if I sit down and I calculate how much I spend on a monthly basis, and then I multiply that by 3 or 4 months worth, how much is that going to be? Over $10,000. When am I going to get this money saved up? And so I don't want you guys to get so much focused on the amount. Let's focus on the behavior. Okay, so let's get that behavior going on saving towards that rainy day. And it could be anything you guys want. It could be $20, 50, whatever you guys can afford. After you make your payments, after you put this strategy of payments in place and you have anything left over, put it aside in a savings account, call it emergency fund, and just start putting money there. Don't use it for anything else but an emergency. Because if you start using it, then when that emergency arrives and you don't have anything, you're the only one to blame, right? But if you can, $20, $50, whatever you guys can, put it in a savings account, start saving it there. You'll see that that account is going to start growing. And when you guys see that you guys have a high balance on that emergency fund, you guys are going to feel great about yourselves. And it's going to lead to more savings. You're going to feel great, so you're going to do more of it. Now, when an emergency happens, what could be an emergency? A flat tire, you get sick, for example, now you have to go to the doctor, you have to pay a copay or buy medicine, prescription medicine. All of those emergencies that you were not thinking of, when they happen and you have this little amount saved up, if it doesn't cover the whole emergency, it will definitely help. When I talk about credit, and I mentioned that for those people that don't have an emergency fund or an emergency savings account put in place, having a credit card is also essential because it can take you out of a tight spot and give you the ease and the benefit of paying it over time. Just be careful with credit cards though, because when you use credit cards, eventually if we find ourselves that we are unemployed or we have our hours have been cut, um, we don't want to go down that hole. We don't want to start using our credit cards and then realize that we cannot make those payments back. Okay, so an emergency fund is definitely the way to go. And the way you will do it is just you can usually open up a savings account, which are free. At least with Affinity, our savings account are absolutely free. And then you can just pretty much put a nickname on it, say emergency fund, and then put whatever amount of money you can every time you get paid. Okay. Should we stop paying into 401k and pay off credit card instead? Excellent question. Now, if you there are two schools of thought with this. They There are people that think that yes, you guys should definitely stop making payments towards 401k and pay off credit cards because you want to protect your credit. Now, the other school of thought is that you may want to decrease your contributions to your 401k down to the amount where your company matches your contribution. So what do I mean by that? Let's say your company matches up to 5% of the money you put in, and you put in there 10%. So you may want to decrease your contribution down to 5% because you don't want to lose on that money that your company is giving you also. That's another way for you to save, not towards an emergency or anything and close by or anything happening soon, but it's another way for you to save towards retirement. So if you just stop your contributions altogether, first of all, I don't even know if your company will allow it. I think if you are enrolled in your 401k, you need to at least contribute something, perhaps 1%. But if your company is matching 5% and you bring it down to 1%, you're definitely losing out on the money that the company may be putting up for you, the other 4% that you're not contributing anymore. So what I would suggest is if you're contributing more than the matching cap, bring your contributions down to that amount. That way you have a little more to play with in regards of income, but at least don't lose out on that employer match that they may offer you. Okay. Next, should I use self or a secured credit card to improve my credit scores? Both kinds of. I don't understand about self. A secured credit card, like any other credit card, will increase your score if used correctly. So with the magic with credit is having the acumen and having the skills to be able to manage your credit correctly. So if you have a credit card, you could have 10 credit cards, but if you have low balances compared to your limits, if you are making payments every month and you're never missing a payment, never missing a bit, you are managing your credit. Now, you don't want to leave off on a credit card if you find yourself in a hardship for two reasons. First, a credit card has a limit. So when you reach that limit, that's it, you're cut off. And second, the fees that you're gonna end up paying for using the credit card for that purpose. So interest or over the limit fees, and if you're late fees, right? So think about all of these fees that are come involved with a credit card, and and I would suggest, I mean, in order for you to improve your score, the best way for you to improve your score is to bring the balances down to under 30% of your limits. So if you have $1,000 credit card, make sure that your balances is at 300 or less. That will definitely give your score a boost. And second, always pay on time, whether it's the minimum or a little extra to bring your balances down, but always pay on time. Okay. Next, where to put the energy fund, savings account or CD? It's a savings account. An emergency fund should always be a savings account, not a CD, because a CD has fees and penalties if you decide to break it. And remember, this money that you're putting away for a savings for an emergency fund is for an emergency. If an emergency was to happen this afternoon, you need to have access to that money yesterday. You need to have access to the money right now. So there is no. What about if the branch closed already? Now you have to wait until tomorrow because you cannot withdraw money out of a CD. You have to wait until the morning for you to go to the branch, for you to break that CD, pay a penalty, pay a fee, and be able to use the money. So definitely an emergency fund should always be a savings account. It should not be a CD. An emergency fund is not meant for the money to grow on interest. Usually when you put money away on a CD, it's because you're interested, you're interested on what you can, how much the money can grow within a certain time period, whether it's 6 months or a year, right? And that's why you're always trying to look out at the best interest rate that a CD can give you. An emergency fund is not meant for that. An emergency fund is to have some money there so it can help you in a tight spot, in a bind, help you with getting out of that emergency as quickly as possible. Okay, very good. So with that said, I don't see any other questions being asked this afternoon. So All right, no, I do see one more question in the chat. I have paid a lot of my credit bills, credit cards too, but my credit score still have not increased over 3 months or so. I pay on time and all the time. So I have a score for paying cards on time. My debt to income is 7%. Okay, so it looks like you are in the right track. Usually, you will not see a drastic change on your credit within 3 months. Usually, you will see that score start to increase little by little, and it may take 6 months to a year. Okay, because usually when a credit card company will only report to the credit bureaus once a month, and we don't know when, right? So if you've been making payments on time for the last 3 months, that's excellent, and you're on the right track. But that I think it's too premature for you to see a spike on your credit within 3 months. I think you need to continue that behavior, continue the way you're managing your credit, and eventually you're gonna start seeing that score go up. Now, there may be other factors in your credit that may not allowing it, not allow it to go up as fast as you want it. And perhaps it's those collection accounts that you mentioned before, or perhaps is there's other accounts out there, for example, a judgment. I don't know if you ever had a repo, a bankruptcy. There's so many different kinds of accounts out there. A lien, a tax lien, for example. So it's really hard for me to tell you what's the real reason why you haven't seen a spike on your score. But there are many different reasons um, that could be causing it. That just because you're making your payments on time, which is great, is what everybody should be doing. But those other little problems that you may or may have had in your credit in the past may be causing it not for the score not to go up as fast as you want. And you just put it in the chat. Thank you so much. You had a repo 5 years ago. So this may be the reason. A repo stays in your credit for 7 years. So if you only had it 5 years ago, it may not have the same effect that had 5 years ago when it happened, but it still be if you happened 5 years ago, it's still being shown on your credit report. So I don't want to guarantee anything, but this may be one of the accounts that is not allowing your credit to increase as fast as you want because it still shows there. But usually a repo only stays in your credit for 7 years. And if it after of course after being paid, after being taken care of. So hopefully 2 more years and you'll be free of that account. Okay. All right, yeah, and another member says here, I have a repo that will that hurt me in getting a home loan? It depends on how long is the repo happened. It depends on how when it happened. If it's recent, then yeah, it will definitely affect your ability to get a home loan. If it happened years ago, and you paid off the account and you've been able to establish credit since then the effect on getting approved for a home loan will be less. But that will be something that you will need to discuss with the home loan officer once you're ready to apply. They'll take a look at your credit and they'll see what's going on, and they'll recommend what will be the best course of action for you to take in order for you to be approved in the near future. Okay, very good. All right, so that concludes the chat, and that hold on a second. I think something was no. That concludes the chat, and there are no more questions in the Q&A. Fantastic. So at this point, I would like to bring this webinar to a close. Thank you everybody for attending. I think you guys are a great group, great questions asked this afternoon. I hope this was informative as well. Please be on the lookout for my follow-up email with the link where I'll be sharing the link to rewatch this presentation. And on that follow-up email, I will be giving you guys the link to register for next week's webinar. I think the next week's is on I apologize. Hold on a second. Let me just take a look real quick. I think next week is on investments. One sec, let me take a look. Yeah, investing 101 is next week. So that will be a great webinar to attend if you're looking to get into the market and start the your investment journey. Okay. So with that said, I would like to bring this webinar to a close. Thank you, everybody. Hope to see you guys next week, and have a wonderful afternoon. Okay. Bye bye, everyone.